Good morning, ladies and gentlemen. Welcome to the Tungsten Corporation PLC interim results investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged. It can be submitted any time via the Q&A tab situated in the right-hand corner of your screen. Click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard, and you'll be notified once these are ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Paul Cooper, CEO, and Ian Kelly, CFO of Tungsten Corporation PLC. Good morning.
Good morning, and thank you, thank you to everybody who's joined. I'm conscious there's, I'm sure, a mix of people who know Tungsten relatively well and people who don't. So just to frame the agenda for today, I'll run through an overview and provide some insights into the investment case for Tungsten, and then we'll get into more specific results in terms of our interims, both from an operational and a financial point of view, at which point I'll hand over to Ian. So just very quick introductions. Paul Cooper, CEO for Tungsten. I joined 6 months ago, having spent nearly 2 decades in the technology industry with a financial background, working through various operational, financial, and leadership roles in the Dimension Data and NTT Group. And very, very pleased to join Tungsten 6 months ago and to share some of the insights that that I've had through that period. And I'll just hand over briefly to Ian for a quick introduction.
Hi, Ian Kelly. So I joined Tungsten 2 years ago as Group Finance Director, been CFO pretty much since all my time here. I've done a half a year stint as Chief Commercial Officer as well, which has given me a great view of the operations side of the business. My background quite varied: technology, professional services. So yeah, as I say, happy to be here to talk through the results today.
Thanks, Ian. So as I say, more for those that aren't so close to the Tungsten business, I thought I'd give some background. And Tungsten is a very well-respected and well-established global business transaction network. Certainly one of the pioneers of electronic invoicing, going back 21 years ago. Just some statistics in terms of transaction volumes over the network from last year, and all of these transactions really in support of some of the world's largest organisations. Realising their digitisation and digital transformation agendas. So just over 18 million transactions over the network last year, worth 220 billion across 196 countries. And one particular strength of Tungsten, which I'll talk to in a little bit of depth, is our compliance footprint from electronic invoicing and from a government gateway point of view. So Tungsten up there with the market leaders, having coverage in 54 countries from a compliance point of view. And our employee base really spread across 5 locations in the US, the UK, Bulgaria, and Kuala Lumpur in Malaysia. And that's supplemented by a number of outsourced teams from a technical, a finance, and a support delivery perspective as well across India, the Ukraine, and Bulgaria. So in terms of the opportunity that gets the management team very excited every day, our initial market playing to the strengths of Tungsten on the accounts payable side is a market estimated at 1.8 billion. I'll come to the product set that expands into accounts receivable, and that market at 3 billion. And then if you go into adjacent markets around procurement and payments, clearly the markets get a lot larger. And not only are they significant markets to be in, the growth rates vary from analyst to analyst, but even as we sort of come through endless phases of the pandemic, the predictions are still that the market in each of these areas is between 10 and 15%. So from a blended 10% growth market point of view for Tungsten, as I say, that's quite a mouth-watering proposition for everyone at Tungsten. And there are 3 key drivers. Regulatory drivers I'll come back to, because it does play nicely to the compliance capabilities of Tungsten. And digitalization is inherent, as I said, and we're already part of that journey with some of the world's largest organizations. But one thing to highlight really, and has always been there in terms of Tungsten's core strength and proposition, and that really is, the power of electronic invoicing. from and only 20% of invoice transactions are in a digital format today. So there's still this huge opportunity for us in the paper and PDF environments to convert to electronic, and you can see a 63% saving, in terms of processing invoices from $8 to just under $3. And at a time when inflationary wage pressures are emerging and look to continue, this really does stack up in terms of a business case, and we have many examples, where we can demonstrate realizing these sorts of efficiencies on behalf of our buyer network. And in terms of that customer base, this is something we're really proud of at Tungsten. You can see the longevity from a buyer point of view to have an average 10-year engagement with a number of the world's leading organizations. On the supplier side, if you look at our integrated suppliers, which is at the top tier of that supplier network, the tenure is even longer at just over 15 years. So really good base for us and platform for us to build from. We have shared geographic splits previously in annual reports and other investor updates that are slightly different to what you're seeing on screen, because we looked at the HQ base of our customer network rather than actually where the transactions are initiated. So what you can see on screen here is a better picture based on those transactions, and certainly spreads out more into Europe, Asia Pac, and rest of world. Whereas the HQ view is quite heavily towards North America and the UK. So, good balance there, and more reflective, I think, as I say, in terms of our global footprint and the compliance trends that are driving some of those volumes. And then from an industry sector point of view, again, a nice healthy balance. We structure our sales teams into three groupings of verticals, and that's really just to help with messaging, to help with referenceability. We are seeing a number of our new buyers want to see evidence of Tungsten perform incredibly within their markets, but in real truth, our products are quite agnostic. There's certainly some customization required, and again, plays to the strength of Tungsten. One thing we refer to quite regularly is our white glove service. So we will tailor a number of requirements, whether it's information on invoices, field mappings, certain buyer rules, etc. We embed those as a custom offering. So so that does lend itself certainly to some industries that want to see certain data sets reflected on their transactions. And just a sample, on our website, again, we're very proud of a number of the customers we've had for many years, and there's plenty of case studies that we share, showing both what these companies were setting out to achieve, and then ultimately what we've been able to deliver for them. So there's just a handful of some of the fantastic logos that we have in our customer base. And, just on products. So this is a little bit of a busy representation, but really there are 5 core products for Tungsten. The traditional total AP products, so that's on the accounts payable side, and you can see a lot of sort of interactions, I suppose, from a transaction and connectivity point of view into various networks, and again, some of the government connections, which I'll come back to. We have our workflow product. We have our total accounts receivable product over on the right-hand side there. And then we have 2 products delivered through partnerships on supply chain finance and payments. So coming quickly back to workflow, that is an on-premise, highly customizable solution that we offer, to about 50 customers on our network at the moment. We've actually just released a more standard version of that, again on premise, but certainly a more cost-effective and more of a plug-and-play option. And more excitingly, we're about to launch Universal Workflow, which is an ERP-agnostic, cloud-based workflow product, and that will be going live very early in 2022. Then on the total AR side, this does create a level of differentiation for Tungsten. There aren't too many competitors in the market that offer both AP and AR. So we are able to provide 100% digitization of outbound invoicing on the accounts receivable side. And the whole Tungsten business model is predicated on what we call the network effect. So, in AP, we land with a buyer, we sign up as many of their suppliers as possible, giving them the greatest amount of cost efficiency, visibility, and connectivity. And then on the total AR side, we can position outbound invoicing into a buyer network, which gives us the opportunity again then to flip an opportunity, and so the cycle continues. So and what we are seeing also is a bit of a shorter sales cycle on the AR side, because there is slightly less complexity in terms of doing the straight through transaction processing from buyers into that supplier network. On the AR side, typically it's a single outbound invoice, and we're into an enterprise grade environment, that again lends itself to cross sell and upsell. So, and we are seeing our pipeline mix gravitate, slowly but surely to a healthy balance of AR beyond the 7 clients that we've signed up to this point. And then I'll come back to supply chain finance and payments when we come to our strategic partnerships. But just, compliance is really one of the icebreakers in terms of conversations I've had with our customers. They look to Tungsten really to continue our knowledge and our robustness of the network in dealing, not only with a single country requirement from the outset when they regulate invoicing, but also keeping up with the changes. And some of those mandate changes can be as complex and significant as launching a new country. And we're in a peak period as it happens at the moment, about 3 times a year. These changes come from the various country governments, and at the moment, we're working through Italy, India, Greece and Mexico with some quite significant changes, and we take on that burden on behalf of our buyers, and as I say, from those particularly in international geographies emanating out of the US, where this hasn't quite emerged as a significant trend at the moment. Then clearly Tungsten is able to offer that level of comfort, and we're up there with the market leaders with the coverage. So we continue to invest in compliance. We want to invest further, as I say, just to keep up with what we know is a wave that is coming from a regulatory point of view, and I'll come back to. So the second part of compliance really is the concept of government gateways, which is integral to countries as they roll out the regulatory invoice requirements, and each of the countries is slightly different, and their changes come at quite short notice, it seems. But really, at the extreme of this environment, countries like Italy, who were the first under the European directive to pilot what is effectively a clearinghouse type gateway, they've been able to close down an additional €4 billion of taxes in the first year of its implementation. And I think we know as we governments start to try and recover some of the investments that they've had to make economically within their countries, in response to the pandemic, this will certainly be a pretty effective mechanism to do that. And you can see the trajectory there on the left-hand side of countries that are launching government gateways. Some of that's purely electronic invoicing, some of that goes into reporting and other areas. But at the moment, we've got connections into 20 countries with mandates, both from a B2B and a B2G point of view. And as I say, the challenge then for us is to make sure that anytime there's a change in each of those countries, that on behalf of our customers, we're making sure that they can sleep at night, knowing that their invoices are firstly compliant, and secondly arriving as they should into these gateways. Then from a strategic partnerships point of view, as we continue to build out capabilities in wider P2P, the most mature partnership is certainly on the supply chain finance side, and Orbian are a market leader, with a fantastic platform that we've integrated into. So we had our first client go live last year, and we're seeing volumes and both in terms of assets under management and the number of suppliers that they bring on board increase with every month. So that was certainly a successful first engagement, and our second large client is about to go live in February. So again, we've enhanced the platform, and continued to make sure that visibility and the user experience in terms of pursuing a supply chain finance offering for buyers and suppliers on the platform is as optimal as it can be. And then FIS WorldPay is another exciting partnership for us, slightly earlier stages and still working through pipeline opportunities. We've lined up our account teams and pursuing a referral model in effect to try and establish demand and ultimately how we develop our integrated payments proposition. So we're sort of scoping that technology and product side at the moment, but at the moment there's still quite a high level of excitement and expectation really around positioning again from a market leading payments provider, the ability to effectively process paperless payments, which is really the objective of FIS WorldPay, using the V card as the primary mechanism to do that. And then upstream of that, we sort of more tactically at the moment responding to opportunities with a few e-procurement options. One with a market leader and one with more of a niche player. And at the moment that's more, as I say, as the opportunity arises for us, where there's more of an upstream requirement for e-procurement, then we'll respond to that with a partner as well. And that's certainly more effective at the moment in terms of a model rather than acquiring or building. And then I'll hand over to Ian for more detailed views on financial performance, but certainly for the interim results. But I guess just to highlight the journey that Tungsten have been on over the last 6 years, and maybe not worth reflecting too much on the early years, but a £20 million turnaround over the course of the last 6 years, and you'll see the trajectory continues in FY22. So a really positive story for us, and underpinning that, more importantly, is maximising the amount of annuities that contribute to that result, which clearly makes us leverage those long-term relationships, allows us to make more certain investment decisions and drive forward. So Ian will share the mix of and what constitutes recurring and repeatable revenues, but we have stabilised at sort of the 93-94% sort of proportion of our business, which is really encouraging. And so just to come back to this morning's release, and as I say, Ian will then build on from a financial point of view. But some of the pleasing outcomes for me is signing up a new AR customer in Zurich that was announced. We start with a country set of about 4 or 5 countries initially, and then clearly there'll be a much bigger opportunity for us. As we find with many of our existing customers, we talk about a white space opportunity, which is part art, part science in terms of understanding how many volumes of invoices are in their respective environments, how much share that we have of that, and therefore what the addressable market is. But really, we have been able to go through our account reviews and identify ongoing significant opportunities for us to upsell in effect and grow with our customers, whether that's into different geographies, into different spend categories, or into different divisions of those organizations. So achieving 13 upsells against 3 in the same period last year, I think is a really good validation of the focus that the account teams in our client management area have achieved. And we continue to drive pipeline both on new deals and upsells going into H2. I already touched on our second large customer under the Orbian partnership. So that definitely again will help us in terms of refining the product and and negotiating better margins as we move forward. And then Amazon. So to be clear, this is Amazon Business. I've had a few clarification questions from people who may interpret that as Amazon Web Services, but Amazon Business have been a supplier on the network for a little while, and we recently signed up a partnership with them that helps them solve one of the challenges that they have in their marketplace model. So a lot of their the POs that come into Amazon Business from their buyer network will then translate into around 7 supplier invoices, which then are in a PDF format. So the opportunity for us really was to integrate with their punch out system, be able to convert those PDF opportunities into electronic, consolidate multiple invoices into single invoices, aligning to purchase orders, and move forward. So early days, but very exciting to be working with Amazon Business. We've done 2 pilot customers, just to test that integration model that we've got. And as we move forward, we have both Europe and the US covered under this recently announced partnership, which does lend itself well as an opportunity both to buyers already existing on the Tungsten network, also to Amazon's buyer base, whether they're on the punch out model or on the web procurement model that they also have. Then from a transaction volume point of view, I mentioned 18.3 million invoices last year, which was actually slightly down about 4% from the previous year. Clearly, the pandemic impacted a number of our buyers in different ways, but starting to see some gradual recovery. Q1 was actually even more positive, and but for the half we've sort of settled at around a 5% increase year on year in terms of our transaction volume. So again, continue to sort of ride out and show the relevance and resilience of Tungsten throughout the course of this pandemic that continues to introduce uncertainty and challenges for a number of our enterprise clients. But as I say, promising at least to see some year-on-year improvement. And again, some of that will be driven in countries where we see compliant invoicing rolled out. The before and after situation in terms of the impact on transactions can be quite dramatic. Nearly doubling what we've seen, particularly in the likes of India, Germany, and Italy. We've certainly seen volumes double from pre-mandate to post-mandate. Ian will share with you some of the sort of positive signs that we're starting to see on the AP buyer side of the churn management. I think we've certainly learnt a lot and implemented a number of measures since the significant client loss that was announced last year. But even on the AP supplier side, we've managed to bring down churn from a level of 12% to 8% in the half. Some of that naturally comes from better management of the buyer churn, but equally, I think really our focus on the supplier experience. So we launched Customer Connect, which was a portal that enabled suppliers to sort of self-serve and access other suppliers on the network and other buyers, to connect and making that process a lot easier than calling into Tungsten. And then equally, we're about to launch Supplier Connect, which is a product that will make the onboarding a lot easier, again, from a self-service point of view and a visibility point of view for suppliers. So all of that focus on making sure that the user experience for suppliers as well as buyers, we'll make sure that we can retain the suppliers on the network. We signed a partnership with a US bank 2 years ago, and there were about 21 buyers that were utilizing an AP automation product on that platform. They did have an electronic invoicing requirement, and we sort of road tested that, launched that. We've had two buyers sign up at the moment, and as I say, about another 20 now to go after from an AP buyer point of view. And then the next two points in terms of internal, I touch on sort of products and how we continue to refine our platform. But even internally, I think we've still got opportunity to realize automation and the efficiencies that come with that. But the journey's already started. Last year we saw ticket volumes reduced. We implemented, more self-service options for the customer experience as well, which took away, quite a number of the overhead that we've had to carry. But as we continue that journey using RPA and machine learning in our internal environments, we'll continue to see the sorts of reductions in ticket volumes and ticket resolution times that you can see there on screen with 17% in the half. So at that point, I'll hand over to Ian to run through some of the financial results of the interims.
Thanks, Paul. So revenue grew from 18 million last year to 18.3 million this year, which is a reported growth of 2%. But it is important to understand that 1/3 of our revenue streams sit in the US, and the dollar weakening this year versus last year has had an adverse impact on us. On a constant currency basis, our revenue growth year on year would be 5%. And I'll come to a bit more of the drivers behind that shortly. Our recurring and repeatable revenue, broadly the same, a slight increase from 93% to 94%. These are two KPIs we do look at. And just to give a quick explanation, our recurring revenue is effectively our annual license fees. So effectively fixed fees, our annual subscription fees. Our repeatable revenue are the volumes, i.e. the number of invoices we process and store archive. A particular good news story for us was our increase in adjusted EBITDA from 0.8 million last year to 3 million this year. That represents an increase from an EBITDA margin of 4% to 16%. The big driver behind that is a significant reduction in our operating costs, primarily around our payroll costs, where we undertook a significant restructuring program last year, which delivered annualized savings of 3 million in the P&L, with half of them coming through last year and half of them coming through this year. Net cash, I'll talk about shortly as well, but net cash, an increase of 900k year on year. And that's primarily driven by an increase in our operating cash flow. Paul has mentioned, new customer deals and upsells, total contract value worth 900 million. That adds about 250k of annual recurring revenue to our customer base. And I'll talk through churn a little bit more when I talk through the revenue drivers as well. But we've seen a significant reduction within our buyer churn base. H1 last year, the annual recurring revenue associated with the buyers we lost was circa 207k, and that's dropped to 54k this year, which is obviously for us significant inroads in the right direction and a testament to the churn improvement program we're undertaking at the moment. So just going into a little bit more detail on the P&L itself, I refer to recurring and repeatable revenue as our metrics on revenue. Recurring revenue has dropped 500,000 year on year, a decrease of 4%. But also, as I mentioned, we have seen an adverse FX impact, which has cost us 400k in recurring. And there's a churn impact of 500,000 here, partly offset by revenue from new customer wins. I'll be coming on to the revenue bridge shortly, but worth calling out that with the churn of 500k year on year here, circa 400k of it is churn brought forward from the previous financial year. So the actual churn impact from churn this year is a lot less. Repeatable revenues have increased 1 million year on year. Two significant drivers here. We put through a number of price increases in December 2020, primarily across the supplier base, which were long overdue. And we are making sure now that some of the RPI increases we put through are going through on a yearly basis. But the price increases we put through last year represented a catch-up of a number of years, and broadly look to monetize all of our transactions as much as we could. And they involved price increases within our annual fees from £920 to £1,000 across our integrated supplier base, We also took away the 523 transactions some of our customers were getting within the annual license fees. And we also increased some of the charges around one of our other products, Webform. And that led to a $1 million increase year on year. And we also expect to see a similar size increase come through next year. We're currently working through our 5-year plan at the moment, but our guidance figure next year also does already have 3 to 4% of banked revenue coming into it via pricing increases from last year. And then probably the big ticket item here is, as I mentioned earlier on, operating expenses down by 2 million. We took circa 55 heads out of the business as part of the restructuring activity last year, and we've obviously seen the benefit of those costs come through this year as well. So I mentioned going through the revenue bridge just now. This shows some of the big ticket items, how we get from 18 million reported revenue last year to 18.3 million this year. You'll see that we're down £700,000 on FX, which I called out. However, saying that, next year we expect the US dollar to strengthen, and that will actually add revenue back to us next year, which will be a good position to be in, because over the past few years we have suffered from the exchange rates going against us. Churn, I mentioned 500,000 in total, but 400,000 of that relates to churn that had taken place in FY21. So it's the carry forward impact into this year. But yeah, the churn relating to this year's churn a lot lower at just under 0.1 million. Pricing, I mentioned the price increases that we put through last year, and transaction volumes 300k up. So transaction revenue 300k up year on year, driven by an increase in our volumes. So we've gone from 9 million to 9.4 million this year, with an increase of 5%. We're not back at what I would call pre-COVID levels just yet, but we are seeing the recovery to get there. So adjusted EBITDA, as I mentioned earlier, last year we had 0.8 million. We're now at 3 million for H1 this year. The big ticket item is effectively the payroll savings year on year, 1.8 million, which I referred to earlier. There has been a significant one-off this year of £400,000 relating to restructuring costs associated with our former CEO departing earlier on in this financial year. And we've seen systems costs come down 400k year on year. There isn't particularly one big supplier within here, but we recruited a new procurement manager about 7 or 8 months ago, and he, alongside the IT team, have been working very closely and trying to actually really reduce our IT cost base, which is paying dividends at the moment. So focusing below EBITDA and profit before tax, some of the call outs here. Last year we did take an impairment in the first half of the year. No need for an impairment this year. Our 5-year plan for the following year is pretty much where we expect to be. And as a result of the impairment we had taken last year, and we also did take an impairment in the previous financial year as well, we've probably flushed out a lot of the risk around that. Probably worth our calling out as well on a foreign exchange gain and loss. Whilst the swing does look quite significant, 1.4 million, and they are quite big figures, these are non-cash items. We do have a large intercompany position between the UK and the US. Under accounting rules, we have to revalue those positions, which translates into quite large figures on our P&L, but as I say, not cash. And then exceptional items worthwhile. The 1.2 million this year is effectively relating to the settlement of an employment claim that commenced in the last financial year, which we actually issued guidance on earlier on this morning. That's not sat in our cash yet, and we'll be paying for that in the second half of the year. Last year's costs 1.8 million were primarily restructuring. So whilst there's been a decrease of 0.6 year on year, not quite in the same buckets as we have a genuine one-off this year relating to the settlements. Talking about cash, so our cash flow, our net cash flow was an outflow of £200,000 this year versus 2.2 million this time last year. So an improvement of 2 million. The bulk of that 2 million you'll see from the top line is driven by operational cash flow, which primarily comes from the reduction in our cost base, tighter working capital management. And last year we did have a number of restructuring payments in the first half of the year as well. As I say, the payment of the US aren't reflected in these figures. That will come through in the second half of the year, but we're not expecting to have to draw down further under our RCF facility. We do have a 4 million RCF facility in place with our bank that expires December 23. And at this point in time, we've drawn down 2 million. We were over the past few months, we were in a position to effectively think about repaying it, but we also knew there was the US risk out there as well, which we're using to settle. But as I say, we're not expecting to actually improve. But so we're not expecting to increase the borrowings. And on the balance sheet, I don't think there's really that much to talk through here. The only big ticket probably swing here is within our current liabilities. Whilst it's a decline of 300k year on year, you do have two big items offsetting there, with a reduction in our trade and other payables of 1 million, primarily due to our reduced cost base, offset by the provisions relating to the settlement claim I just mentioned. And then looking forward to the rest of this financial year in the future, just giving a quick update on Outlook. Our guidance does remain unchanged for FY22. We were behind the number of customer wins that we would like to have had in H1, but to a certain extent, we did actually make up for that with our upsells, which were higher than we anticipated. And we've a pipeline for H2, and there's a number of new customer wins that we are hopefully will be coming through in the next month or two, as the decision-making cycle from 6 to 9 months now coinciding with some of the customers in our pipeline as we get to final stages. I talked about the FX impact. The exchange rates aren't expected to move that much in the next few months to have an impact on FX for us going forward. But the FX hit that we've taken this year will already flow through into FX for the whole of the year. I mentioned earlier on when I talked about the 1.8 million worth of savings from payroll. Probably worth our calling out within that there was some timing of about 300k worth of payroll costs, as we are going to actually invest more back into the business in IT and compliance. Originally we had planned for that to happen a few months ago, but that will be ramping up those activities in Q4. And on cash, we will be expecting to pay 1.5 million out in December and January for the claim that we announced today. And with that, I'll hand back over to Paul.
Okay, thanks, Ian. So just to sort of finish off before we get into questions, and again, important for moving forward, just wanted to share, I guess, a real summary view of Tungsten's overall strategy, and our purpose, remains the same. Every enterprise client and even below that level, are looking to to digitize or transform digitally, and the invoice is central to that. It's a non-negotiable. So our mission is to make sure that we maximize the value of the invoice, upwards and downwards in the supply chain, and all of our pillars of strategy gravitate around growth. Firstly, play to our strengths on the AP side. I talked about white space. We've been able to quantify what we believe is the addressable level of untapped invoicing volumes in our existing client base. You've seen that we've, with a bit of focus, we've managed to secure some good results there in terms of our upsells. And attached to that really is making sure that once we secure the buyers and maximize the invoice volumes, is also making sure that we're able to bring on the suppliers to maximize, as I say, both the efficiency and the visibility for our buyers, but also create that that revenue opportunity and the network effect for us at Tungsten. Then secondly, we spoke a lot about compliant countries and gateways. So there is a wave that continues to come, certainly through Europe, and over time, we're starting to see some lead indicators that the US is preparing for more advanced regulatory invoicing requirements. Their equivalent of PEPOL and EESPA, who are bodies that look to standardize sort of the protocols around electronic invoicing requirements. There's now a similar body created in the US. So so that's coming. I'm sure that's likely to be state by state, but nevertheless, again, just plays to our strength of dealing with complexity in these environments. On top of that, we have a plan to open the network effectively. So traditionally we probably haven't explored relationships with too many what we call interoperability partners, and that can be so that typically is where a supplier will already have an existing partnership. So typically these entities will be competitors for us. We will be margin challenged because there's a cost that is at the other end of an engagement with an interop partner. But we had about 30 interop partners coming into the year. We've already added 6, and and we have a pipeline of another 15 or so moving forward. So whilst there is a margin challenge with there, again, for the benefit of our buyers to get full visibility of transactions, if we need to then deal with an interop partner to do that, we're starting to see demand for that. And then I touched earlier on our partnership strategy around wider P2P capabilities. So definitely seeing traction on the supply chain finance side, and we continue to position that with a very mature pipeline into our existing buyer base. FIS WorldPay and the payment strategy is not too far behind that. And as I say, tactically positioning e-procurement capabilities as well as and when. And then Total AR, because it does differentiate us to a degree in terms of not too many competitors offering both AP and AR. We've now secured 7 customers along the journey, with different complex environments, different ERPs, different sort of constructs in terms of mappings, from the outbound invoicing. So we've been able to sort of solidify that product. We've actually got bundle pricing that we can now go to market with on Total AR, and then we'll continue to leverage any add-on features that we can with our Total AR as a growth opportunity for us. So finally, before questions, just coming back to the elements of the investment case I spoke to earlier, just as a reminder, we're in a growth market, and in a couple of growth markets really, so that really is something that we with our 5% constant currency growth, we're not quite meeting that benchmark, but that clearly is the aim for us. We've got that fantastic customer base, and we brought in a new chief sales officer just over 2 months ago, and he's very energized about the prospect of building out, and building from the enterprise client base that we've got, and equally putting more focus on the suppliers, and we continue to enhance that supplier experience as well, given that that's a revenue stream for us. The Tungsten platform has been built over 21 years. It's been a huge investment. It's robust. There's definitely modernization required in certain areas, just to adapt to some of our SaaS capabilities, adding APIs with our partners, etc. But it's scalable. It can certainly take more volume and our products as they bolt on to the platform will continue to fuel the roadmap as we go forward. Compliance we spoke about heavily, just that is a wave that's happening and will continue to come. So we definitely feel very confident about the team and the products that we've got around compliance and the value that does in terms of being the safe pair of hands for our enterprise clients and them avoiding significant investment on their side to internally deal with a lot of complexity that comes with the establishment and the change landscape of those gateways and electronic invoicing. Strategic partnerships, not just the P2P. Equally, we spoke briefly about Amazon. We also have a number of BPO or outsource partnerships as well that we can leverage, and that is a trend certainly in our market that outsourcers come in and not just offer P2P breadth, but they also go wider than that, and particularly in the enterprise space, look to take on various environments upstream and downstream and into IT, into HR, etc. So we're certainly looking to join a bit more proactively in terms of the established BPO relationships we've got, and then also build out a handful more. And then we talked about the financial profile and visibility. I think clearly we're turning a corner slowly but surely, and very excited about sort of the trajectory that we can see and the path to continued profitability. And really now, the focus remains to do that, as you can see with the strategy around our top line growth, with both market share and wallet share within our existing network as significant opportunities for us moving forward.
Fantastic, Paul. Ian, thank you very much indeed for your presentation. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated in the right-hand corner of your screen. Just while the team take a few moments to review those investor questions submitted already, I'd like to remind you the recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. I'd also like to remind you that your feedback is important to the team, and immediately after the presentation has ended, you'll be redirected for the opportunity to provide your feedback in order the company can better understand your views and expectations. Paul, Ian, we've had several questions posted during the meeting itself. If I may just ask you just to click on that Q&A tab and start at the top, and where appropriate to do so, just read out the question and give your response, please.
Okay. Your interim results today state net interest paid of 300k in the last 6 months and lease interest paid 175k. What are you paying interest on if you have no debt and have cash? What interest rate are you paying on both pockets of debt, lease and other? Probably just worth clarifying that the lease payments and interest aren't what I would call they're not loans as such. This is the change of accounting rules under IFRS 16 2 or 3 years ago, when effectively we have to treat all of our operating leases, such as rents, as lease assets. So that's really an accounting issue. We're not paying lease interest as such. It's just the change of accounting for operating leases. We do have debt of we do have debt, which is the current RCF facility of 2 million. The interest we're paying is circa 3% on that. And probably also worthwhile pointing out as well that within that 300k, it's a mixture of it's not just interest, but there are it's basically our bank charges, credit card charges, all finance cost payments that going through there as well. And the 125k increase year on year, worthwhile calling out. That's not a cash impact. It's worthwhile calling out that there's FX in there as well, which is we do have a number of working capital positions and loans, as I've just mentioned. So the evaluations does have an impact on those as well. Okay. So I think that answers that question.
Yep. Thanks, Ian. And let me take the tough one. So what's the story on the US litigation? So yes, quite right. We, as Ian said, we had to announce an unfortunate piece of news this morning in parallel to our interims having concluded a settlement process late Friday, with an employee claim against Tungsten for an employee based in the US. as the RNS says, and we can't share, a whole lot more, just because of confidentiality associated with the agreement. But we absolutely refute the claims. We'll certainly learn and embed any changes that we need to make in terms of bolstering the management training and any of the processes that we've got at the moment. But it has been a very unfortunate outcome. I think really sort of following legal advice, and the settlement really was the only course of action if you looked at the potential costs of going to trial and the range of possibilities in a US-based employee litigation that may have emerged. So we believe we've done what we could in terms of the best outcome for shareholders, and really look forward to moving on from such an unfortunate situation. And then the next one was, what is the financial impact forecast from the recently announced Amazon partnership? As I said earlier, I mean, we're really sort of excited and energized by the prospects from our side and from Amazon's. I think a lot of the planning and the work that's gone into sort of productizing the solution from their punch out system into our environment is certainly filling us with a lot of hope and expectation. But it is early days, as I said earlier. So we've only recently worked on sort of a multi-year model. It is a bit difficult to say at this stage. We've got, as I said, the 2 pilot clients or buyers on our side that we've tested the solution, and that will give us a good benchmark. Typically there'll be varying degrees of usage of Amazon Business. They have a pretty similar footprint in terms of being in the majority of FTSE and Fortune 500 companies. So we're working through that overlap opportunity, and in those clients you can see generally somewhere between 50 and 70,000 invoices in from an Amazon Business point of view. But as I say, we need to assess that against as many buyers as that we can. Not everyone's using Amazon Business, clearly. But we're working on that sort of joint growth plan now, having a lot more confidence that the solution works, and that we offer something that will truly add value both to Amazon in terms of scaling where they need to get to, and ultimately buyers and suppliers on the Tungsten network. Okay, and then maybe I'll move to one. Just a quick one maybe for you, Ian. Apart from the existing 2 million credit facility, do you anticipate any need for further funding during 2022?
So I was on mute. No, not at this point in time. As I mentioned earlier on, I think we've got a good view of our outlook for the rest of the year. There's nothing else out there apart from the material, which is a surprise to us. We can steer through. I think the reality is, funding we're talking about in the future will be for growth and for capex, but we don't need funding to manage our working capital position at this point in time.
Great. Thanks, Ian. And then we had a question. Please, can you talk about the competition, and in particular, who do you currently lose business to? I mean, we come up against various market players in various scenarios. I guess one to touch on really is and I mentioned it briefly earlier, is particularly in the enterprise market, the prevalence of outsourcers, BPOs. So the client loss that we announced last year really was that scenario. Equally, the cancellation of the contract with NTT that we shared was along those lines as well. So I mean, if one sort of positive, I suppose, to take out of that is the experience of the client that did give us notification they'd be leaving has resulted in us extending that transition initially by 3 months and then by a further 3 months, which sort of shows you how customized and how embedded the Tungsten mapping and focus and what I referred to earlier as a white glove service. All of the sort of customization's gone on over many years for that client, is really becoming a struggle for the outsourcer to unpick, and it was a cost-based decision. As I said, they took a much wider landscape on, and therefore we became a victim of that. But equally, conversations continue because as a best of breed electronic invoicing partner, we can handle that complexity that now clearly others are starting to struggle with. So as I say, on the flip side, we definitely can continue to focus with outsourced partners that we've got that are already into our buyer base, and continue to work with them more proactively. And even if we're playing a small part of a wider engagement, we definitely have a role to play, as a best of breed provider. Any other questions? Maybe this one, Ian, I know I think we've shared this previously, but can you run through the typical sales process for a new client win and the revenue profiles you obtain? Also, can you comment on revenue visibility?
We actually did a slide last year, actually, which we called it the journey revenue flow of a new customer. But I'll just talk through probably the real life scenario of one of our buyer wins last year. But the revenue associated with the buyer itself over 3 years was circa 300k. But we expect over the life of the contract 3 years. Well, our total contract value we tend to calculate for 3 years, but as Paul mentioned, a lot of our customers stay for a lot longer with 10-year average tenuurship. But it's over a model of 3 years. Worth understanding that if a buyer comes to the table, in this case with revenue of 300,000, we expected about another 350,000 pounds worth of revenue from our supplier base to add to that as well. Effectively, when the buyer joins on day one, we will reckon we will have the revenue associated purely with the buyer that year. The onboarding process can take from 6 to 9 months. But as we sign up more suppliers, either via our web form product or our integrated supplier product, we will see the revenue streams associated with those suppliers build up gradually over time, with a significant ramp up in year 2 and year 3. So and it changes the mix. It does change the mix of the revenue actually. You'll see from the stats that our supplier revenue was circa 62%, our buyer revenue 38%, and that's what the profile of the model suggests. That effectively, when you're signing a buyer up over the 3 years, the mix of buyer supplier revenue will shift very much towards the supplier revenue, providing most of the revenue associated alongside that buyer.
Well, Ian, I know we're just coming up to the hour mark, and of course, if there are any further questions that do come through, you will be able to review those, and we'll publish responses where appropriate to do so on the Investor Meet Company platform. And Paul, perhaps before just redirecting the attendees to give you some feedback, if I could just ask for a closing snapshot, that would be great.
Yeah, sure. Very quickly, just thank you everyone for attending, and really appreciate you making the time. As we've sort of seen some mixed results there, but some real positives. I think even at mid-single digit growth from a revenue point of view, that's promising off the back of 2 relatively flat years, and some real positive signs I think in terms of moving forward with transaction trends, pricing increases, some of the pipeline opportunities, and that focus on upsell, which really is starting to show some positivity, as well as managing the churn. There's no point winning new logos if we can't retain the maximum amount of buyers and suppliers onto the network. So so I think, as I say, the team have worked really hard. I think very proud of most of the results that we've seen, and improved operating margins, and also sort of break-even free cash flow, which is also important from an investment point of view. So hopefully the story resonates, and we continue to try and see that that path to profitability on that trajectory and drive that largely through top line growth, continue to invest in the platform, continue to invest in the user experience, and really keep this trajectory going in the right direction.
That's fantastic. Paul, Ian, thanks again for updating investors today. Can I please ask investors not to close the session and should be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of the management team of Tungsten Corporation PLC, we'd like to thank you for attending today's presentation. That now concludes today's session. Thank you and good afternoon.
Thank you.